Hey, what's going on, my friends? It's your man, Adam A. Spencer, here with another M1 Finance dividend portfolio update. But today, the most important question I got to ask you guys, do you still have your drip? I know you see the hat, you see the Celtics logo up there. It's dripping, right? I ain't even talking about that type of drip. And I know some of you might be like, oh yeah, I got this new necklace I just bought, some bling bling. Nah, I ain't talking about that type of drip either. I'm talking about a dividend reinvestment plan, because recently the market has been getting hit pretty badly, right? Pretty badly. And a lot of people are out there starting to wonder, they're starting to question and saying it's looking a lot like the dot-com crash again. So it brings up the question, is the economy headed for an early 2000s style recession? Now, I'm not going to read this whole article, but I do want to throw out these numbers. The S&P 500 is down 19%. I've heard 20% at this point. And the tech-heavy NASDAQ has fared even worse, plummeting over 28%. But we could be just halfway through the stock market decline based on historical trends. Between March 2000 and October 2002, the NASDAQ 100 sank 78% as once loved but largely unprofitable tech firms fell by the wayside. It was a dot-com bust that washed out a slew of tech sector darlings that had ruled the 90s, and there's a startling similar trend today in the market that didn't exist decades ago, and that's cryptocurrencies. The crypto market has lost roughly $1 trillion in value year to date in one of the worst sell-offs in the maturing market's history. Now, I share this with you guys to help put things in perspective because the whole market is doing horrible. I mean, really bad, especially as I mentioned, kind of tech-heavy companies and startups and whatnot. So, our growth portfolio, for example, is getting hit pretty badly. And when you jump over here and you look at our dividend portfolio, you can see, hey, over the past day, we're only down 0.03%. So that might seem kind of positive, right? However, when we look at the past week, you can see we're actually down 3.6%. The past month, we're down 9.56%. The past quarter, we're down 8.11%. 1 year, we're down 12.83%. So all time, we're down 8.80% with our dividend portfolio, which gives us a current value of $2,176.82, which is a gain of negative $125.98. Now, because this is our dividend portfolio, you can see our market gain is actually higher. It's actually $204.62, which is basically how much money our stocks have gone down for where our average stock price is for each stock we own. But because of our earned dividends is $78.64, you subtract that from the total market gain, which gives us the negative $125.98 gain that our whole portfolio is seeing. This gives us a current value as of today, which is Sunday. What's today? Sunday, May 22nd, 2022. A current value of $2,176.82. Now, if you guys are new to this channel, we invest $25 every week into our dividend portfolio here. And even though the market is not doing so well right now, we are staying true to our drip. Now, we're going to continue with our update. We'll jump and see if we've received any dividends so far or any new dividends since our last update last week, and also see what stocks are performing best in our portfolio. But before we do, I want to share with you exactly what I mean when I talk to you guys, when I ask you guys if you got drip. Like I said, I don't care about all that flashy stuff. You trying to look cool, you trying to get some girls because you got a new necklace and all this. You wasting money on. No. I don't care about all that, right? Now, yeah, if you're investing in gold because you know or believe gold is going to go up in value in 10 years and 50 years and 100 years, okay, that's cool. I get that. But if you're doing it because you just trying to look the part, you trying to act like, look at me with all my drip, all blinged out and this, that, that ain't me. I mean, that's some of y'all. That's cool if that's you. I don't want to hate. I don't want to seem like I'm hating. Do you? But me, I'm more worried about my meaningful drip, about my future. And what I'm talking about is, again, that dividend reinvestment plan. So the first question that some of you guys might be asking, what exactly is drip? I pulled up this article. We're not going to read the whole article, but I am going to read this opening section and possibly a little down at the bottom. And I'll post a link to this article in case you guys don't want to, stick around for this. If you want to just jump into the article yourself, you can do so. And also feel free to skip ahead if you want to continue with our M1 Finance traditional update. But like I said, we're going to talk about drip because I'm staying true to my drip with this dividend portfolio. So the question is, what exactly is a drip? First, investors buy into stocks that pay dividends. Dividends are regular profit sharing payments to shareholders, typically delivered once each quarter or once a month, depending on if it may be a REIT. A lot of REITs pay, for example, monthly, but generally it's going to be once a quarter. So as long as the company has some kind of dividend program, you will get a fixed payment for each share that you own. Some of the oldest and most reliable income stocks to buy are called dividend aristocrats. Dividend aristocrats are companies listed in the S&P 500 with a track record of 25 years worth of increasing dividend payments to investors. Second, reinvestment means that you deploy those dividends in your investing strategy and buy even more shares rather than taking that money and spending it elsewhere. So even if you only start with 100 shares of a given stock today, you may have 105 shares in a year or two, or 1,500 shares eventually if you're patient. A drip then is a simple way to immediately deploy cash in this manner so you don't have to watch your bank account, then manually purchase a handful of additional shares after you get paid. Plenty of investors do this on their own, as hundreds of stocks and funds offer direct drips to investors. On top of that, many online brokerage platforms also offer support for automated dividend reinvestment plans. So chances are, if a stock has a dividend, you can set up a drip. If you're looking to strike it rich quickly with Wall Street, then a drip may not be right for you. But if you're after a long-term and lower risk approach to investing, dividend reinvestment plans allow you to steadily accumulate more and more shares without using any additional cash out of your own pocket. Now, like I said, we actually had AT&T in our portfolio before, so it's funny that they used them as an example. In with our particular strategy that we have with our portfolio here, we are employing this drip approach, but we're also combining it. We're doing like a dollar cost averaging strategy where we continue to invest in this portfolio on a consistent basis. Meaning, regardless of how well or how bad right now the economy is doing, we continue to invest $25 every week. And by continuing to do that, we're buying more shares, but then we're also employing this drip strategy where our dividends that we're receiving are being reinvested in our M1 Finance portfolio. And this, for what we're trying to do with this portfolio, we just want to accumulate more and more shares of the companies we have in our portfolio and just let it kind of work itself out. And setting up that auto direct deposit where we just automatically have the $25 connected from M1 Finance to our checking account allows us to automatically pull that 25, and it's going to take care of every purchase every week for us. That is the beauty of M1 Finance. But one drawback I want to point out, as they mentioned here in this section here, again, I'll post a link to this. I'm not going to read this, but sometimes, you might prefer to actually spend that money, or you might prefer to get your dividend payouts and then reinvest that money somewhere else and buy some other stocks instead of putting it back in those same companies. So that's where, it may not necessarily work out as well as it could, because you can potentially see greater gains elsewhere if you, deployed your dividend payouts in some other, stock that might be running more than what your companies are in your dividend portfolio. And of course, you have the tax implications of, hey, this is essentially, although you're not getting the cash in your pocket, essentially that's what you're doing. You're getting the cash, but then you're putting it back in your dividend portfolio. So from a tax standpoint, they're going to tax you because that's cash that you're getting and whatnot. So something to consider as well and keep in mind. And there are other kind of, drawbacks to it as well. But we're not going to dive into that since I don't think they are as great as the rewards are for employing some sort of dividend, drip plan that also includes a dollar cost averaging strategy, similar to what we have here in this portfolio. So when we scroll down and look again, our current portfolio, we're down 8.8%. The market is doing horrible. I mean, S&P 500, as we mentioned, down 19% since the start of the year. Others have said 20%. NASDAQ plummeting over 28%. So we're seeing across the board, stocks are getting hammered and hit really badly. So when we dive into our particular portfolio to see who is doing well, who's not doing so hot, off the rip, you can see we have Coca-Cola here at the top, who is up 26.69%. Then we have PepsiCo up 22.09%, followed by Johnson & Johnson up 16.03%. Realty Income Corp up 14.41%, and Procter & Gamble up 8.35%. However, in the red, we have Newt, who is down 3.66%, followed by Verizon Communications down 7.35%, 3M down 26.16%, JP Morgan and Chase down 32.28%, and Innovative Industrial Properties down 49.9%. So the reason I wanted to kind of dive into not only how the overall market is doing, but also introduce you guys to the concept of a DRIP, of a dividend reinvestment plan, is to help introduce you guys to strategies that some people have implemented to help them with growing their money. And that's exactly what we're doing with this portfolio. Despite the market being down right now, we are not changing our plan. We're staying true to our drip. And I think, if you're new to investing right now, it's probably you're getting nervous. You're looking at your portfolios. You're like, ooh, we're down 8.8%. We're down 15%. Our growth portfolio is down like 70% or something crazy. I mean, people are getting hammered and hit really badly. And if you're new to investing, this is tough, right? This is really challenging because it's all your hard-earned money that you've invested in, a particular company or portfolio. And, then the market's just kind of tanking. It's not doing so well. It's, your money, you're seeing your money kind of just disappear right before your eyes. But the same way it kind of disappears right before your eyes, it's going to kind of potentially, I don't want to say this is guaranteed. It's not legal or financial advice, of course, but it probably will reappear right before your eyes in due time. Now, that due time might be 3 months. It might be a year. It might be 3 years. It could take some time. So taking this drip approach where we're dollar cost averaging and continuing to reinvest our dividend payouts allows us to buy more shares, especially when they are at these cheaper prices right now that we're experiencing. But even, when maybe the prices are a little high, we're still staying true to our drip. Because again, this is a marathon. It's all about the long term. We're not looking at the short term gains. We're not trying to just, become a millionaire tonight with this portfolio. It's not going to happen. So you want to be realistic, right? You can be optimistic, of course, but be realistic as well. Set, expectations that we could, not only reach, but surpass, instead of making it too much of a reach where this portfolio is not going to blow up to $1 million overnight. And it's going to be hard doing so with $25 a week too. You might have to increase your weekly contribution if you're trying to get to that $1 million with this type of portfolio. So little things like that are important to keep in mind as you continue to move forward with your investing journey. We're not changing anything over here. Even when you look at our earned dividends, you can see New Tech is killing it compared to everyone else at the top of our list, where they paid us $20.38, followed by Verizon Communications, who has paid us $9.27, and Realty Income Corp, who's paid us $7.90. So notice all three of these companies, I mean, they're not the top three performing companies in our portfolio right now. That goes to like Coca-Cola and like Pepsi, things like that. Other companies that, again, aren't in our top three earned dividend accounts. So, there's drawbacks to having certain companies over others. And again, depending on what your plan is, if you have a drip plan where you're going to reinvest those dividend payouts that we just saw, well, all of that money that we just saw on that last screen is being reinvested back in our portfolio. We don't get that put in our pocket and go out shopping and splurging, get some new drip. No, we put it back in our dividend portfolio to buy more shares, more stocks of the companies we have in here that we believe will continue to perform well and do well over the years to come. So the one other thing I wanted to jump into is the activity, and we will just see, as you can see for this month, we'll just do a little recap for our dividend payouts that we've received. Procter & Gamble paid us $1.30 on the 16th. Realty Income Corp paid us 79 cents on the 13th. And Verizon Communications paid us $2.73 on the 2nd. And JP Morgan Chase paid us $1.57 back on the 2nd as well. So, yeah, I mean, as a whole, my friends, considering how the overall market is doing right now, I'm actually not, it might sound surprising to see, oh, you're down, you're losing money, and you're not mad. You're not, yeah, I'm not mad. I'm not actually mad. I'll be honest. I'm actually kind of happy. Like, hey, we're holding up fairly strong. Again, our growth portfolio update yesterday, brutal. Check that video out if you haven't seen it yet. Our growth stocks are getting hit hard, really bad, just like the overall market is kind of feeling it. So, like I said, we're sticking with our plan though. We're not changing our drip. Now, yeah, you might want to hop in the shower, wash your clothes, whatnot. Yeah, you want to change your drip every once in a while. But you get what I'm saying. You don't want to change your strategy, especially during these times. Now, you might, maybe you do. Maybe you don't have good companies that you believe in. Maybe you don't think they're going to necessarily rebound as well as other companies might. So that is completely fine. And I think it's always healthy and good to consider reevaluating your strategy and your plan. However, it's also times like this when people panic, they sell. And once you sell, you took a loss. Whereas all the stocks in this portfolio, I believe, are going to rebound. And yeah, I got some REITs in here, some that are a little more volatile or iffy than others. And I'm willing to gamble with some of them, right? By gamble, I just mean take a higher risk. And as they say, with higher risk comes greater reward. So I have a lot of value-based companies that I really believe in that I think will be completely fine. Then there's 2 or 3 in the mix in this portfolio that might be a little more iffy, a little more risky. And, I did that intentionally where I have a little risk, but most of this is reliable, proven companies that have been able to withstand years and years of bear markets and recessions and this, that, and the other. So we are not changing our drip over here. We're keeping things moving, keeping things rolling forward. I'm going to continue to invest $25 every week. We'll continue to reinvest our dividend payouts that we receive and, just try to grow our bag, right? Some people, oh, you're a bag holder. Yep. I want to be the biggest bag holder with this portfolio. I want to have hundreds and thousands of shares of these companies in this portfolio. That would be fantastic to me, but that's just me. Some of y'all, shorts and whatnot, they'll try to make it out like being a bag holder is horrible. I mean, hey, ask Warren Buffett about being a bag holder who's accumulated hundreds and thousands of shares of stocks, and now we can see what his net worth is worth. So I'm going to leave it at that. I'll let you guys, obviously be your own financial advisor and whatnot, strategist, and, deploy your own plan, your strategy. I'm just kind of sharing with you guys one of my plans, one of my strategies that I have, at least with this particular portfolio. So you guys can start investing with M1 Finance as well by clicking on that link down low in the description area. If you invest, deposit $100, they'll hook you up with some money. I also have a link to Webull, another platform that I use where same difference. If you invest like $100, they'll give you some free stocks that you can then watch or add to your portfolio and, maybe start your own little drip. But hey, I'm going to wrap it up there. I hope you guys found this video helpful, motivational, encouraging. If so, definitely smash that like button. It does help with the YouTube algorithm. And it also lets me know you guys enjoy and appreciate this type of content. And of course, if you haven't already, feel free to subscribe to the channel. Hit that notification bell so you can stay up to date on all of our latest and upcoming video content. But all right, my friend, you already know what it is. I gotta keep it moving, but I'll see you in the next video. Peace.